Here are 5 of the best ETFs for long-term investing in a Roth IRA. Now, the benefits of a Roth IRA is that it will save you tens of thousands of dollars in taxes in retirement. A Roth IRA will give you 100% tax-free growth, and even the dividend income that you receive will be 100% tax-free. So you could, well, truly live off of dividends and capital appreciation. You can take out contributions at any time, just not profits until you're age 59 and a half, because this is a retirement account and I hope you retire before you're in your 60s. You can contribute up to $7,000 per year as of 2024, which comes out to just $185 per week to max out the contributions before that April 15th deadline. So in this video, I have 5 different ETF categories that you should consider to invest in your Roth IRA that have been proven to be some of the best investments for any investor to hopefully get rich by the time they retire, all completely tax-free. I'll touch on some of the ETFs from every single category and even how much money I have in each ETF in my Roth IRA portfolio for transparency reasons. So without further ado, let's get started. The first category of ETFs is dividend ETFs. Dividend ETFs should without a doubt be in your Roth IRA because it's my #1 choice of ETFs to actually put in your Roth IRA. All the capital gains and even all the dividend income is going to be completely tax-free. So if anything, you can truly live off of dividends forever without paying any taxes to the IRS. Now, some of the best dividend ETFs that I like are SCHD, DGRO, VIG, and JEPQ, amongst some other great dividend funds as well. Now, I do own SHD in my taxable brokerage account, but in my Roth IRA, I own DGRO at a little over 27 shares and over $1,600 total in this fund. Because DGRO has some of the best dividend growth that I've seen from the dividend investing world, because DGRO only invests into stocks that have been consistently growing their dividends year over year. These stocks have great capital appreciation, and also their stocks are into many different industries, so you are diversified into a broad range of sectors. Currently, DGRO has a dividend yield of around 2.2% with excellent dividend growth over the last 9 years, where it has been able to grow its dividend over 9% every single year. DGRO has a very low expense ratio of just 0.08%, awarding it an A+ rating by Seeking Alpha. It has been awarded a gold star by Morningstar, which means that DGRO is as legit as it comes for an excellent dividend growth fund and is quite the achievement. The top sectors are in financials, healthcare, information technology, industrials, and consumer staples, with the top companies within the ETF are JPMorgan Chase, Johnson & Johnson, AbbVie, Apple, ExxonMobil, and Microsoft. The returns of DGRO are excellent, of over 11% returns annually over the last 5 and 10 years, which is just insane to think about for a dividend growth fund that is going to have great capital appreciation alongside a growing dividend. The second ETF category is going to be a broad market ETF. Some excellent broad market funds are going to be S&P 500 index funds, total stock market index funds, and lastly, total world index funds. Why broad market ETFs are amazing is because you get instant diversification to hundreds, if not thousands, of different stocks from the stock market that are going to be into many different industries and sectors of the market. You also get a really solid dividend yield for passive income, and broad market ETFs are one of the easiest and stress-free methods for long-term investing, and probably one of the most popular investment methods that investors choose for their Roth IRA. For the S&P 500, I like VU, SPLG, and IVV. For the total stock market, I like VTI, SCHB, and ITOT. And finally, for the total world funds, I like VT. Now, I do have VTI at 100% of my 401k, totaling over $11,000, and it has been treating me quite well with some pretty good gains. But in my Roth IRA, I have VU at over $2,200 in its balance at just over 4 shares, but I do have VU as well in my taxable brokerage account with over $60,000 invested into the S&P 500, or over 115 shares in that taxable account, but that's besides the point. VOO has a dividend yield of nearly 1.3%, and it has an almost non-existent management fee of 0.03% with an A+ rating by Seeking Alpha. It has 500 of the best companies in the USA from top sectors like information technology, financials, healthcare, and consumer discretionary. The top companies in the ETF are Apple, Microsoft, Nvidia, Amazon, Meta, and Google. Over the last 10 years, it has had a great performance of over 13% returns annually. And the S&P 500 has had a great performance since 1957, making it a very strong and reliable ETF, which is why it's a very hard index to beat for investors over a long enough period of time, which is why Warren Buffett loves it as a great strategy to buy and hold forever. The third category is going to be a bond ETF or fixed income category. Bonds in a way are safer, less volatile than stocks, and a great way to preserve your capital, and as well to provide some steady stream of income of interest payments prior to the bond's maturity, which makes it a great investment either before, at, or even near retirement. Bonds typically earn a fixed amount of interest even if the interest rates get cut. If there is a rate cut, then bond prices will increase and interest rate yields will fall. But if you invest before a rate cut, you could lock in higher yields. Now, the majority of experts think that the Fed is likely to cut rates in September of 2024 and beyond, and so the days of earning a 5% yield on your savings or a money market account may be gone very soon. However, Public introduced a new way to lock in a yield of 6.9% before interest rates decrease with their bond account. What makes Public's bond account unique? Well, instead of buying individual corporate bonds, you can now invest in a diversified portfolio of investment-grade, high-yield bonds with an initial $1,000 investment. Unlike a savings account with a fluctuating interest rate, with Public, their bond account has a fixed yield for the duration of the bonds. That means that if you invest, you can literally earn a 6.9% yield for literally years. Many investors believe in building a portfolio that has a mixture of stocks and bonds to improve diversification, and the bond account with Public is just one way to do that. Of course, diversification does not eliminate risk. Please do know that the yield can change daily and can be different from the yield shown on today's video, on Public's app, or on Public's website due to rate fluctuations. Please go ahead and check out the link in the description of this video to get started on your own Public bond account with an initial investment of just $1,000 to lock in high interest rates even if the Fed cuts rates. Thank you so much, Public, once again. Now let's get back to the video. The fourth category is growth ETFs. Growth ETFs are amazing and great for investors who have a higher risk tolerance, perhaps a longer time horizon, as well as that can stomach the volatility that comes with these higher risk investments in hopes of outperforming the S&P 500 and giving high returns in the long run. My favorite growth ETFs are SCHG, VGT, QQQM, and SMH, amongst some other great funds in this category as well that can shoot up to the moon. I own QQQM in my taxable brokerage account with over 83 shares and just over $16,000 invested in this fund, but in my Roth IRA I have SCHG by Charles Schwab at just over $4,500 in value and over 44 shares, which makes up the highest holding in my Roth IRA. Growth ETFs typically have a high portion to technology stocks, which can lead to significantly higher returns than most of the market, but please note that that means that the risk of this ETF are going to be higher all across the board. SCHG has a low expense ratio of just 0.04% with an A+ rating by Seeking Alpha. It has a high portion of technology stocks and also other great sectors for diversification like communication services, consumer discretionary, healthcare, and financials, with some of its top holdings being Apple, Nvidia, Microsoft, Amazon, Meta, and Google. SCHG also has some of the best and highest returns of the ETFs on all this list of over 16% annually over the last 10 years and over 19% annually over the last 5 years. and has even crushed the S&P 500 in returns over the last year, 3 years, 5 years, and even the past decade, making this ETF a very strong choice if you want to grow your money as fast as possible, perhaps with less risk than maybe individually picking stocks, because you have an ETF that has some of the best growth stocks in the market. The fifth category is super underrated, and that's small cap ETFs. Small cap ETFs are a very rewarding way to invest in the stock market if you want to have some higher returns and perhaps seek to invest in some fast growing companies, and it can be very, very rewarding. The problem with ETFs like VU, QQQM, and SCHD, and so many more is that these ETFs are all only large cap ETFs, meaning that they only invest into large cap companies. With small cap ETFs, you add more diversification into your portfolio than if you didn't have them otherwise, because you now have small cap and now large cap ETFs in your portfolio to diversify your money. And with small cap ETFs, you add more exposure to have a complete ETF portfolio if you do throw them into the mix. My favorite small cap ETFs are AVUV, IWM, VBK, and AVDV. My personal favorite is AVUV, the Avantis US Small Cap Value ETF. It has an expense ratio of 0.25%, awarding it a B+ rating by Seeking Alpha, but the cost of the fund is going to be a touch higher than the funds that we talked about in this video, but it's going to be well worth it given its most recent performance of over 12% annually over the last 3 years and over 20% annually over the last year and 17% since the life of the fund annually back in late 2019. AVUV is a very well diversified fund with some top sectors like financials, consumer discretionary, industrials, energy, and materials, with some of its top holdings like GATX Corp, SM Energy, Matson, Boise Cascade, Mueller Industrials, and Jackson Financial. AVUV has actually outperformed the S&P 500 over the last 3 years and even over the last 5 years, even though we are missing some data from 2019. But that's besides the point, because small cap ETFs are a very powerful way to hopefully increase your wealth over time to have a ton of money in your retirement in your Roth IRA. Now, if you guys like this video, please give it a like because this cute puppy did. And right here is going to be a video on some of the best dividend ETFs for the dividend snowball. And right here is going to be a video on my own 3 ETF portfolio strategy. Now, I love you guys so much. Continue to crush it in the stock market and take it easy. Peace.